Hello, everyone, and welcome to Trading the Eurex Gateway to European Equity Index Markets. I'm looking forward to exploring these ideas today with you. They're relevant markets to things that are going on globally, especially in the European area. But before we get into details on that, I need to tell you just a little bit about risk disclosure. This presentation is for educational purposes and informational purposes only. Just like any investment, futures and options have risk. And it's important that we understand those risks before we make those investments. Also, I want you to know that Eurex and Advantage Futures is not endorsing, nor am I affiliated with those organizations. I am here just to share ideas that I found helpful for me that I hope you'll find helpful as well. My background is I come from the floors in Chicago, so I think about the markets from a floor trading point of view, and I've been blessed with the opportunity of circling the globe a couple times a year through a word-of-mouth network, and it's given me a chance to be involved in a variety of markets, a variety of countries, over 36 different exchanges, 450 institutions, and 35 countries. And what we're going to be talking about today, I see when I travel through Europe, and as well as other countries that are paying attention to the activities that are happening there. We are all connected. So what happens in another part of the world, it's very relevant to you and I. Now, what you're looking at, trading the Eurex gateway to European equity markets. There are many compelling reasons to consider trading on Eurex, including the unique geographic exposure Eurex products offer for trading and hedging risk in the Eurozone. You might be familiar with several of the most popular European equity index benchmarks, such as the Euro Stocks 50 and the DAX and the Mini DAX 30 index futures. These are indeed some of the most active Eurex equity index products, both in terms of volume and open interest. But today, we're going to focus on two of the most rapidly growing Eurex products. And then we'll close with an emphasis on the upcoming French election and a timely potential trading opportunity related to the Eurex's Stocks Volatility futures and the Eurex Stocks Europe 600. A broad-based equity index futures. As shown in the green on this slide that you're looking at there, 2017, the average daily volume and open interest have grown strongly in both the VSTOXX and the Stocks Europe 600, based on a variety of recent and anticipated events. The VSTOXX average daily volume has grown over 20% year over year and now sits at over 50,000 contracts per day. Open interest, it's jumped to from 220,000 to over 370,000 contracts year over year. The Stocks Europe 600 average daily volume sits at a healthy 50,000 contracts per day, with open interest rising over 20% to nearly 300,000 contracts. So the question is, why have we seen these Eurex products grow so rapidly since last year? Well, here's the answer. Volatility and global uncertainty fueled by Brexit and the US elections have created increased interest in similar events, namely the French election in April through May, and then the German elections in September. Opportunities abound for participants to take direct advantage of the European markets movement with Eurex products. Eurex truly does offer the gateway to Europe. As you can see in this chart, with the increasing volume and open interest, trading broad-based Europe with the Stocks Europe 600 is clearly in the spotlight and increasing. As interest surrounding fundamental events in Europe increases, so does participation in this broad-based hedging tool viewed as the benchmark for the entire European stock market. Comparing Stocks Europe 600 as the S&P 500 of Europe, well, it's really a very accurate point of view. One interesting observation is that we see significant volume increases in off-exchange or OTC or over-the-counter activity around the March, June, Sep, DECE expirations. See those large spikes there? Well, this increase in activity and the fact that open interest is seen rising in tandem, what it does is it validates the fact that traders and investors are holding and rolling large Stocks Europe 600 positions as a part of medium and long-term plays on the European markets. So why look at the Stocks Europe 600? And what you're looking at on the slide, on the left, you can see the participation of the capital markets from various countries, which we're going to talk about, and the regional areas that we're covering. Well, in the United States, market participants are only beginning to absorb the implications of Donald Trump's young presidency. We've all seen the impact that has had on global equity markets. Now in Europe, the upcoming elections in France and Germany threaten to upset the status quo across Europe. Consequently, market participants welcome an index with the broad pan-European representation of the Stocks Europe 600 index. Now, I got to tell you, this alone is a compelling reason to keep the Stocks Europe 600 on your radar. It's important to watch it, but it also is Europe's leading broad-based benchmark and a unique barometer of the overall European market sentiment and subsequent sectors. With the fixed number of 600 components, the Stocks Europe 600 index represents large, mid, and small capitalization companies across 18 countries of the European region, capturing 90% of European country-specific activity. So it's no surprise that the Stocks Europe 600 saw significant movement during recent political events based on a variety of countries represented by this product and their respective percent contributions to the overall index price. I mean, the UK represents approximately 30% portion of the Stocks Europe 600. So consequently, we saw significant movement following the Brexit vote last year. Along the same lines, over 79 of the 600 Stocks Europe 600 components, 15% are French. You know, the index is comprised of such company names like Christian Dior, L'Oreal, Peugeot, Vivendi, and financial companies as well, AXA, BNP, Crédit Agricole, and SocGen, just to name a few of the 79 French companies that make up this index. So there's a lot of interest in the upcoming French elections, with the expectations that this index will likely again move in reaction to the French election results. Now, there's a link at the end that highlights these French components that we'll talk about later on. And before we leave this slide, I just want to give you an idea of how this does compare to other famous or well-known indices. I mean, if we look at the Nikkei 225, that represents 60% of the Japanese total market cap. The S&P 500, the most broadly referenced index in the United States, well, it covers 75% of the US total market. We're here with the Stocks Europe 600, we're at 90% of the capitalization of that region. If you were going to set this up yourself, imagine setting up stock accounts in all these countries and then pick the stocks. Imagine all the transactions you'd have to go through. You and I can do it with just one transaction. And what we can feel comfortable with, it truly does represent the European equity markets. Now, looking at things through a focused lens, well, on this chart we're looking at here for the V stocks, let's take a closer look at another important regional trading and hedging tool, represent the 50 largest companies used in the Euro Stocks 50. And that's the Eurex's V-Stocks Volatility Futures and Options. Now, many of you are familiar with one of the most common tools used in the US for trading volatility, and that's the VIX. Well, for years, market participants have been using the VIX as the proxy for trading any type of global volatility. However, as demonstrated by the moves we've seen in Europe last year, European markets have their unique reactions to monumental events taking place in the region. The turmoil in Europe related to the refugee exodus and influx, the Brexit vote, the European banking crisis that we've seen in Europe and Italy, and this year's French and German elections, all impacting volatility in the Eurozone. So, smart participants are using the appropriate tool for trading and hedging equity market risk in Europe and Eurex's V-Stocks Volatility Futures and Options. V-Stocks is Europe's volatility benchmark designed to reflect the investor's sentiment and economic uncertainty by measuring 30-day implied volatility of the Euro Stocks 50. Now recall that volatility indexes have a negative correlation with equity in markets, and they often serve as leading indicators of movements in the underlying equity markets. When one rises, the other one typically falls. Now, Eurex V-Stocks futures and options have monthly expirations, and they're reaching out 8 months into the future. It's no surprise we have seen a large positioning, record open interest, and a dramatic rise in volumes in the 2 monthly volatility futures and options expirations straddling the French elections, the April 2017 and the May 2017 expirations. Now, we've explored why it's vital to monitor the Stocks Europe 600 into the French elections, but these V-Stocks volatility products, I got to tell you, they're equally important. With 18 of the 50 V-Stocks components coming from France, this volatility measure is currently weighted at over 34% French. So looking at the composition of the V-Stocks, it's clear why there's such a high level of interest in the Eurex stock V-Stocks complex. And again, we have a link at the end to if you want to look at those components, and we'll look at that a little bit later. Well, why look at the V-Stocks volatility measures? Since the V-Stock reflects European specific market sentiment and the European macroeconomic environment, it is the most appropriate tool to hedge outright exposure to the EU equity markets. For instance, looking at the top of this chart you have in front of you, the inverse correlation between the V-Stocks, now that's the green line that you're looking at, and the European benchmark equity indices, that's the blue line that you're looking at, increased throughout recent political periods. Looking at the bottom of the chart, while European V-Stocks and the US VIX use similar index calculations, there are some stark differences between the US and the European volatility measures. The V-Stocks index is fundamentally valued at a premium to the VIX because the V-Stocks is more concentrated. The V-Stocks is based on the Euro Stocks 50, an index of 50 stocks, as compared to the VIX and the S&P 500, which is an index of 500 stocks. Plus, the V-Stocks components are often more volatile. Well, since 25% of the V-Stocks and the Euro Stocks 50 components are financials, compared to the 17 or so and a half percent in the VIX and the S&P 500. Now, the V-Stocks VIX spread, it's volatile and mean reverting, but it breaks down, especially during times of European and US specific crisis. Since January of 2014, the spread has averaged 5.47 points. Now, I'm talking about the V-Stocks over the VIX. That means your long V-Stock, short VIX. The Greek crisis In June of 2015, the spread went to 13 due to the Greek crisis. And then it went below 1 in August of 2015 when the U.S. equity markets tumbled. In June of 2016, the spread went over 20 due to the Brexit and continues to react dramatically to EU-specific volatility events. So in summary, the U.S. continues to be a strategic part of the VStocks growth for Eurex. A new marketing program in VStock futures has already shown positive results as liquidity and volume in the order book, it's improved significantly. And listen to this, VStock's options are now available to trade for those of you in the US. And there's also new ETNs, the exchange traded notes, on the VStocks, and that's going to be available soon too. If you're looking at relationships between the European equity markets and the European volatility, you should have the Eurex VStocks volatility product on your radar, as surging volatility in the run-up to the French election has ignited considerable interest. And as we both know, using the proper hedging vehicle is critical in order to capitalize on macro divergences between Europe and the US. Well, the French election trading opportunity. Now that we have some background on these two very important European-focused Eurex equity index products, let's take a look at some market opportunities that you and I could think about. Now, for example, this first round of the 2017 French presidential election, well, it's going to be held on Sunday, the 23rd of April. And there's about 4 people right now kind of leading the pack. 2 of them are pro-Europe, and 2 of them are saying we should be getting out of the EU. And so the expectation of any candidate winning more than the 50% majority, kind of a low probability. So the expectation is that there's going to be a second runoff, and that's going to be between the 2 top candidates who received the most votes. And that's going to be held 2 weeks later on the 7th of May. But you know, regardless of which candidate or candidates make it through the subsequent rounds, let's take a look at clues to possible market action that you and I could look at to take advantage of these products. Now, a tool I'd like us to talk about today is behavioral Japanese candles. Just want to tell you quickly that for those of you who are familiar with this technique, I'm not going to be talking about standard patterns. That's not the approach we're going to use. So I'd like you to put your ideas aside on that topic while we're looking at this. And for those of you not familiar with Japanese candle charts, I want you to know that what we're going to be talking about is not the typical approach to this technique. Typically, we would talk about 80 candle patterns. And what I found is who remembers what to do with number 1 or remember what number 1 is by the time you get to number 80. So what we're going to look at today is what I call behavioral Japanese candles. I first saw this technique in the mid-80s at Bank of America in Tokyo. And I was teaching a course on a trading strategy called market profile to customers of the bank. Part of the course, these are yield curve traders, and part of the course was to go into the dealing room and find some trades in 30-year bonds. And I did. We put some trades on. We're walking out, and I see a fellow drawing by hand these candle charts. So I asked the gentleman I was with, Kuno-san. I said, Kuno-san, what are these charts? I've never seen this before. And he said, oh, these are Japanese candle charts. Now, they were kind enough to talk to me about this, but what went through my mind is what it represents. And being on the floor, what you get an opportunity to do is to see how the market absorbs information, how it absorbs order flow that comes to that market to trade. Now, you and I don't have to be on the floor anymore, because that action, the dynamics of a market, well, we can see upstairs using the software that we have available. And Advantage Futures gives you an excellent product to trade from. So what we're going to look at now are these candle charts, and we're going to talk about some of the behavioral aspects. What they do is they draw a box between the open and close, and if the closing price is above the opening price, that box is called the body. I think it represents buyers coming into the market. And the reason for that is competition between buyers that creates price movement. On the other side of your trade is typically a market maker. And what a market maker does, their job is to buy when you want to sell and to sell when you want to buy. And they get paid the difference between the bid and offer. That's their business model. But what causes a trend, it's that order that came into the market that's still being held. And so if I want to buy them at 50 and you want to buy them at 50 also, or let's say we're brokers on the floor, let's go back to the floor. And I bid 51, I get filled, and you bid 52, you get filled, and so on. So throughout the day, we're seeing buyers and sellers coming into this market, and it closes at 60. Why? Well, because more people wanted to buy this market than sell it. That's how I look at this. Just to say the opposite on the other side. When the closing price is below the open, I think that represents sellers coming into the market. And here you have the high, the top of the bottom of the bodies of the candles, and you have the low here at the bottom. Now, we know that that doesn't always happen. Many of you probably know that. And if the high is above the body of the candle, that difference is represented by that vertical line called a shadow. Now, at high prices, I think that represents sellers. When the low doesn't match the body of the candle, that vertical line, well, I think that represents buyers coming into the market. Now, here's what you want to think about. The body itself, well, that represents market acceptance. It represents enthusiasm for the market. It represents commitment. So are the bodies getting bigger or are the bodies getting smaller, which would imply a loss of momentum? The shadows. I think the shadows represent a degree of rejection. So for example, with this green candle, when it traded at the very high price here, that green body would have extended to the high. And during its life, it did, and that would have been a green body at the high. But something happened there. And what we see is a shadow being formed. And the reason we're seeing that shadow is because sellers are coming into that market. And I believe at high prices, a shadow on the top are the footprints of selling that came into the market. Just like the shadow on the bottom would represent buyers coming into the market. So at some point during this candle's life, after it opened, it did trade at that low. And at that point, that would be a red candle, because the price is now below the open. And again, something happened. Buyers started coming into the market, and we see that shadow being formed. And when it traded beyond the open, that would now start creating a green body candle. So the size of the bodies, the size of the shadows are clues for you and I in terms of market behavior. So we're focusing on the behavior, meaning buying and selling, not just a candle pattern. Now let's start out here. And I've got the Stocks Europe 600 weekly on the left, and as you can see, the VStocks weekly on the right. And what we see here is that we see the normal relationship, don't we? Because as we talked about, we expect an inverse relationship between these two products. And when here in the Stocks Europe 600, when it broke to the downside, and you and I see this big shadow on the lows, well, look over here in the VStocks. We see the same kind of action, only in reverse. So what we're seeing here is the market acting normally, that relationship we expect to see. Now, another thing that's important to look at is how it moves. Now, let's go over here to the Stocks Europe 600. See that big strong move that we had there, that big rally? And then look at what happened afterwards. It maintained that upper momentum. And in fact, if you look at this move, it's about a 45-degree or so move here to the upside, maybe a little bit less than that. So we're seeing momentum carrying this market. Now take a look over here at the VSOX. What we see here is the market went sideways. And then as it started to go down, it's been kind of struggling as it's going lower. So when I look at this, there's a couple of things that go through my mind. First, I think about the spread between these two markets. And what we're looking at here is I'm looking at a market that's moving faster to the upside than this market is moving to the downside. And in a spread, typically, what you want to do is you want to buy strength and you want to sell weakness. So if you and I were looking at a spread between these two markets, I would want to buy the Stocks Europe 600 and I'd want to sell the VSTOXX. And what we can also look at is that because of that movement, the spread between these two contracts is getting wider. It's increasing. Now let's do this. Let's take another way of visualizing that difference, because that's what we're going to look at next. Let's look at a spread now between the Stocks Europe 600 and the VSTOXX on a weekly chart. And what we're looking at here is the spread of that difference between those contracts, and it gives us an idea of the rate of change of that difference. And look at what we see here. Starting back actually a little bit before November of last year, right before the US presidential elections. Look at the rate of change of that. And you know, I think it reflects the interest that we're seeing in the Stocks Europe 600. And also slowing down as the VSTOXX, that volatility throttled down a bit. So we see that slowing down. And that creates the opportunity that we're looking at here. So a spread between these markets, maybe that's something that you and I should consider when it looks for looking for opportunity. Now let's talk about what's coming up. Let's talk about that French election for a minute. So what do we expect to see? Well, first, the day of the election, which is a Sunday, and Monday the market's going to open. And so we'll see how the market absorbs the information, whatever is available from Sunday's election. And if it is anti-Europe candidate, we would expect the Stocks Europe 600 to go down. We would expect weakness because it pumps in uncertainty to the market. We would also expect interest rate products to increase. So for example, the Bund, we would expect it to increase, or the OAT, which is a French bond that's traded on Eurex. We would expect those to increase. If it's a candidate that's pro-Europe, well, then we would expect the index to continue going up. Excuse me. And the reason for that? Well, it's because status quo may be maintained. That's why. So we may not get a clear picture when it comes to right after the election of who's going to be doing what, but that second round is going to be also very critical. And that's where we'd really expect an increase in volatility, and I think also trading opportunity. So we have both of these points in time that could give us some clues about what's happening. Now let's take a look then at the Stocks Europe 600. Now what I have here is I have a 15-minute chart, as you can see, and a 7-period simple moving average. And I'd like to think about this in a couple different ways. First, let's just look at the aspect of the candles. And again, we can think about what this could be telling us when it comes to the French election. And let's start over here to the left of this chart. And what you see is a fairly large candle with the big shadow on the bottom. I call that kind of behavior a rejection pattern. It's where you have a very large shadow on the bottom or a very large shadow on the top of a candle. And that implies it's gotten high enough or low enough to find the opposite form of behavior. One of the common ways a market can change directions. So let's start with the one up here on top. We have a large shadow, and remember, big shadow on the top means it was green during its life. Buyers pushed it up there, and then sellers pushed it back down. Now, there's something I want to point out to you, and this applies, I believe, to any technical approach. And that is after you have a buy or sell signal, the next 2 to 5 periods of time, whether it's 15 minutes a daily, weekly, it doesn't matter. But the next 2 to 5 minutes of periods of time, it will give us clues about how to manage this trade. Now, from my point of view, when we look at this rejection pattern, the next thing I'd want to look at is what's the environment that it's trading in. And what we can see here is a large green candle. I call that a benchmark candle. It's the most recent period with the greatest volatility. It shows us the strongest form of behavior that we've had in recent periods. All right, so if I'm a seller a few ticks below that bearish candle, which I have to tell you, I would be interested in doing, then I'm looking for this market to break lower in the next 2 to 5 periods, right? I want to see this market going down the way it came in. Well, look at this. If I sold it at this lower part of the red period, the very next candle, buyers came back in. And the very next candle after that, buyers came back in. Well, son of a gun, 2 periods later, I'm not getting paid for this trade. I'm not seeing the follow through that I was looking for. And one thing that we both would do is that we make sure we know what our risk is going to be for this trade before we ever put it on. If we don't know our risk of how much we're willing to absorb to maintain a position before we consider the position failure, then we should never make that trade. And this is no different. So whatever the number of ticks would be, if I sold it here, if it's 5 or 6 ticks back to the upside, right here, this trade is failing. It's telling me, Dan, you're not getting paid for the trade. Get out. And so I would get out, and I would lose money on this trade, by the way. That would not be productive. And as we look along here, we see another big shadow. And we say, geez, I remember what happened last time. But we have this big rejection, and it could also be connected to the time of day, which I'll tell you about in just a minute. But if I sell it 2 or 3 ticks below that low, look at this one. We get paid for the trade. The next 2 to 5 periods, what is it telling us? It's cooperating. It's productive. That's the trade we're looking for, not the one over here. So as this breaks lower, check out this low. Look at the big shadow on the bottom. So where we found buyers before, over here to the left, son of a gun, we're finding them again. And that rejection that we're seeing here sets up the potential, another trade. But if we were still short, that means a few ticks above this high, we would now be exiting the position. And in this case, the market did cooperate for us. Now, if I was long this market, the next 2 to 5 periods tell me what to expect. Well, this one again happened to cooperate. As it traded lower, what I would look at then is to trail a stop. And if we're trailing our stop 4 or 5 ticks below these lows, you can see we don't make new lows. So the way it would work is if I was a buyer here, my stop is below this candle, 4 or 5 ticks, whatever that is, that's appropriate. Same thing here, we're moving the stop up, every period as it finishes. And here, it probably traded, I would say, a greater amount than 4 or 5 ticks, so we'd be exiting the position. And the market did make new highs, and it did back off. If we're looking at this is what I call it, a dark cloud cover. It'd be one of the ways to look at it. I call it a market getting ahead of itself. But anyways, let's go back to the action that we're seeing. So that would be an example of rejection that you and I could look at. Now there's a couple other things that I think are important for us as well, and that is time of day. If you're going to trade a market whether you're trading it intraday or whether you're trading it longer term, you should have a feel for when the market's volatile and when it's not volatile. There are times of the day that you may want to trade it because you expect volatility, and there may be times of the day we want to hold back a little bit because it typically goes sideways like we see right here. So let's start over here. Now, the times that you're looking at that I'm going to talk to you about are Chicago times, because that's where I am, and I'm using that as a reference. So 1 o'clock in the morning, this market starts a trade. That initial start of the day for these products that we're talking about, I think is very important. The vast majority of the time, probably about 70% of the time, that first 15 minutes to a half an hour can be the low or high for that entire trading session. So I think that's an important reference to set up a potential move. Now, the second time of day that I think is important is around 7 o'clock, between 7 and 7:30. In fact, right here, it's right after 7:30. There's 7:30. This is 7 o'clock, so 7:15 to 7:15 to 7:30. And what we're seeing here, the reason I think it's important at that time of day in the United States is when our interest rate markets open, our currency markets open, our metals markets open. So the cash market is engaged. And what do we see here? We see some volatility. Ooh, and check out what happened right before that. See those little candles? That's typical behavior before you see this market opening to the next time zone. Because what happens, and I deal with a number of those institutions, that, for example, if I'm a European bank in Germany or someplace throughout Europe, I'll even the positions up. They even up before the next time period, the next time zone begins to trade. And that's what you're seeing there. So that's normal. But we see volatility, we see rejection, and we see the market breaking lower. So that was probably off of reports. And it could be that the market is now reacting to something that happened in Europe. That could have set the tone in Europe or something in the United States. But here's the thing, for you and me, we get to trade that. We get to take advantage of how the market's absorbing that information. So when it occurs is important. The next time zone I want to mention, or time period that I want to mention to you, is 8:30 Chicago time, because that represents the opening of our stock market. And that's where we can also see volatility. And right here, this little guy right there is what's happening. It's the next, here's the first 15 minutes, the second 15 minutes of our stock market. And whatever is coming out in the stock market, the market is absorbing here, and the Stocks Europe 600, and it likes it. So it may have a positive outlook. And again, that could be another report, another source of information the market's absorbing. And what you and I get to do is we get to see how the market's absorbing that information. Now, the third thing I want to mention to you on this chart is this moving average. And a 7-period moving average means that the computer, the software program, counts back 7 periods of time, and that uses the closing price to calculate that average price. So you can see here, well, we basically went sideways for a while. So the average of these 7 periods is pretty much right in the middle of that range. Now, what we can do with a moving average, and I wanted to keep it just a simple idea, is another thing that we could look at, is we can use a magnitude objective, and we can also use a filter for trading entry and trade exit. So let's say that we wanted 5 ticks above this open, above this moving average. If we move 5 ticks above it, we'll buy this market. Well, here that would be a buy. And we can see, and we're going to stay in the trade until it moves 5 ticks below that moving average. So it did trade below the moving average, but it's not 5 ticks. Here it did. Right there, you and I would be getting out of that market. And in this case, it happened to be cooperative because we had volatility. Moving averages love volatility. As we break to the downside, we also see another feature of moving averages. Here, we moved about a 60-degree move, right? And the moving average performed just fine. Here, we're falling out a bit. We're doing almost a 90-degree drop in the market. And what happens is that price accelerates away from the moving average. When that happens, if you're using moving averages, what it means is that you're not going to capture this low price, and you don't have to have a profitable trade. But again, we wait for 5 points, and that means we'll be buying it someplace up here. One more thing I want to point out to you about, and you'd be exiting up here, about any technique that you use, is that after trade entry, what exposure do you have to sit through to let this trade work? And I want to show you an example right at the beginning. I said if I was going to buy this 5 ticks above, I'm buying it up here. And eventually you can see the trade worked. And it worked through the European time zone. But also notice this very next candle. Even though it didn't trade 5 ticks below that, what we do see is it traded against us before it became profitable. The amount that it traded against us, you want to look at that as a reference for when the trade fails. So it gives you an idea of how to manage risk with this technique. Let's take a quick look at another example. This is again the Stocks Europe 600. And what you see here is a market that has a rhythm. It's got a drum beat that we're looking at there. We have that nice orderly rally and a nice orderly break. A nice orderly rally, a nice orderly break. Hey, see, here's that benchmark candle that you and I were talking about. And see how the market stayed inside the range of that benchmark candle? The bias for this market is for another move to the upside. And as we started making highs, what do you see up here? We see all those shadows again. So we know this market's making new highs. It's struggling up here. We see shadows on the bottom, shadows on the high. There's no clear sense of direction. And it could be it's waiting for the next time zone. It could be it's waiting for a report. It's waiting for an excuse to do something. But look at the size of these moves. As we look at the rallies, how big is that move compared to the size of the move here? Kind of similar. And the same thing here. So we know when this market moves that amount, you know, it's about 2 full handles, or 2 full points, I should say. I has a tendency to stop and take a breath. So it gives us an idea of what our expectation would be, the normal behavior for this market. Let's take a look then at the V stocks, the mini futures that we've been talking about. Now this is a 120-minute chart, and it's using a 10-period simple moving average. I'm using 120 minutes because of the way the volatility is featured in this particular product. So I'm looking at a 2-hour chart. Also a 10-period moving average. And there's something you want to keep in mind with any technical study. It's the sensitivity of the study to the price action. So here, if I made this a 5-period moving average, it will shift this moving average to the left. If I make it a 15-period or 20-period moving average, it would take this line and move it to the right. It would make it less sensitive to price movement. Now, what we see here, though, we could use the same criteria that we just talked about for our friend, the Stocks Europe 600. And what we see here is I could say, well, X number of ticks above this, 4 or 5 ticks above that moving average, I consider it a buy. And 4 or 5 ticks below, I consider it a sell. That means I bought this over here, and I'm selling it over here. I lost money in that trade. So I want to point that out. But the other thing we have to ask ourselves when you're evaluating a concept or a market is, after trade entry, was the trade ever profitable? And if we look at this, after trade entry, it was profitable. And we could look at the size of that move and find out, after trade entry, is the size of that move consistent? Even though it fails, Is it profitable? And that profitability may be what you and I do, is we say that if I get 5 ticks, I'm in, and if I can get 8 or 9 ticks out of this move, it moves 10, then I'll take it at 8 ticks. We take half the position off at 8 ticks, move our stop to trade entry. So now we're going to get stopped out at trade entry or with this moving average. And in this case, we would have gotten stopped out at trade entry. So some things to keep in mind, but the same kind of issues that we talked about before are present here in this chart. So it's a very orderly move. Look how orderly it moves here to the downside. So when it trends very well. And we can see through this environment, it did a pretty good job. And again, this is a sideways move where the market struggles. But what I find interesting is that it moves far enough beyond or below this sideways move and the moving average that it may give us some opportunity that we may not find with other markets. So just a few things to keep in mind. Now, I got to tell you about a few things here. First, if you're interested in these products, go to this website, EurexChange.com. A wealth of information on the products, the things that you and I have been talking about. And if you want to find more detail or you want some guidance, Timothy Lewandowski, he has some wonderful sources of information, and he's so knowledgeable. He can tell you so much. If you have any questions, he's a great contact for you to look at. And here's his telephone number. That tells you how open he is to helping you understand these products. And these are also some websites, components, and Tim can send those to you if you contact him. Give him a shout, and I'm sure he'll be happy to email those to you. Also, Advantage Futures. Take advantage of Advantage Futures, AdvantageFutures.com. It's another wonderful source of information, of solid information that you can use to help you make informed trading decisions. And that's the whole purpose behind this webinar and what Eurex is trying to do, as well as Advantage Futures, to help provide you with tools for market exposure and to help you make informed trading decisions. Well, I have to tell you, I really enjoyed being with you today. I hope you gained some insights into these exciting products and maybe some trading ideas that you and I want to think about and pay attention to for these upcoming events. I wish you the very best in your trading, and I also want to thank Eurex and Advantage Futures for making this possible for you and I to come together to explore these topics. So again, best wishes for much success. I'm looking forward to our paths crossing again in the future. In the meantime, take care.